And just like that, the yen carryover trade disaster is over. This article here says Bank of Japan deputy governor plays down chance of near-term rate hike and the yen slumps. Bank of Japan's influential deputy governor said on Wednesday the central bank will not hike interest rates when markets are unstable, playing down the chance of a near-term hike in borrowing costs. Uchida said the intense market volatility in the past week could, quote, obviously change the BOJ's rate hike path if it affects the central bank's economic and price projections and the likelihood of Japan durably achieving its 2% inflation target. Quote, as we are seeing sharp volatility in domestic and overseas financial markets, it's necessary to maintain current levels of monetary easing for the time being, Uchida said in a speech to business leaders in the northern Japanese city of Hokkaido. He says, personally, I see more factors popping up that require us being cautious about raising interest rates. Uchida's dovish comments balanced out the governor's hawkish tone last week, said Hiroshi Kawada, senior economist at Mizuho Research and Technologies. Market volatility is so high now that it won't subside soon, which means the hurdle for an October rate hike is now quite high. But there are a lot of analysts pointing out that if the Bank of Japan is abruptly changing their stance, worried about global financial markets, then there could be a lot more pain ahead for the carryover trade when that pain does resume, when the Bank of Japan is forced to raise rates. So I would not say the situation is necessarily over. It's over for now, but it will come back up at some point down the line, either when Jerome Powell starts to lower rates or when the Bank of Japan starts to raise rates. Tom Lee and Fundstrat say today, the VIX falling from 66 to 27 is a positive sign and a further sign this is, quote, a growth scare with the worst likely behind us. The VIX closed at 28 Tuesday, down from 66 peak intraday on Monday, and that Monday reading was the third highest ever after the global financial crisis and after COVID panic lows. Unfortunately, I do not agree with Tom Lee on this. This sell-off we have seen is not a growth scare. It's just not. Like 5% of this sell-off has been a growth scare. 95% of this, in my opinion, is the Bank of Japan, what they did last week, and the yen carryover trade that just started collapsing. I mean, it is what it is. Eventually, we will see a growth scare at some point this year. If the data gets worse, perhaps the data coming out tomorrow could spur more of the growth scare. But this is not a growth scare. It's not. Let's just call it for what it is. This is the Bank of Japan that blew up the financial system for a couple of days. Further validating my point, Ryan Dietrich's post here on X, he says, the week is halfway over. Remember Sunday night when they told us a crash and recession were coming this week? Financials and industrials are up on the week as of now. That isn't bearish if you ask me. Yeah, because it wasn't a growth scare, right? Industrials and financials would not do well during a growth scare. This is not a growth scare. If the economic data gets worse, the labor market does get worse, then we can talk about a growth scare. But Wall Street is not fearful over a recession all of a sudden. Nobody's even talking about a recession at this point. Fundstrat and Tom Lee also write, of the 420 companies that have reported so far, about 84% of the S&P 500, overall 72% are beating estimates, and those that beat are beating by a median of 6%. Of the 20% missing, those are missing by a median of negative 5%. On the top line, overall results are beating estimates by a median of 6% and missing by a median of 4%, and 52% of those reporting are beating estimates. And this really sticks out to me because 72% of S&P 500 companies beating estimates is okay, but it's not great. A great number is 80+%. In the 70s, you're just okay at that point. If you drop into the 60s, that starts to look a lot worse. Now, I would like to share this clip with you from CNBC. It says, Citi's Scott Kroner, we are setting up for an early cycle rotation.
Back down after it spiked earlier this week. Joining us now with his view on the market sell-off, what comes next, Scott Kroner, head of U.S. equity strategy at Citi Research. What were you thinking when it got above, how high did it get, Scott? Do you see it that day? It was well above 50, wasn't it?
It got well above 50. Yeah, Joe. I mean, I'd say obviously it's a shock because we've been living in this low VIX regime for quite some time now. But heck, going back in our ETF work over the years, I think there's been a strong, group of traders out there that when they see these volatility spikes, there's a natural proclivity to want to sell into it because the roll feature that comes with the ETFs on the VIX usually means that there's a better odds that the elevated VIX won't usually persist.
Do you think at this point the highs have been seen on the VIX? I guess that's the same as saying, do you think that the panic that we saw on Monday was that just a one-off, or was it the start of something that could lead maybe to us thinking that maybe the soft landing narrative is suspect?
Well, I think you touched on the key point. I'm not in position to comment on where the VIX is going from here, but these spikes usually are not long lasting. But what I would say in terms of what's transpired, been a lot of discussion around carry trade. There's been a lot of discussion around degrossing. All of this probably feeds into the same narrative that many investors were kind of caught positioned down a path that got upended on three fronts. You lost some of your AI conviction with the NVIDIA news. You've lost some of your soft landing conviction as we're looking at the more recent economic data pointing to higher conviction of a Fed pivot. And then on the election side, there was a very strong view that, you had a pro-business Trump lead that now has been erased. So all three of the forces that in our view had been supporting the market as we were at or near recent highs have had some doubt brought into play, and that's quickly been reflected to a point where we think we're more confident that we're getting close to having priced a lot of that concern in.
Do you think at this point, looking at technical data that we're seeing, Scott, is the lag effect of all the things that the Fed did, is there more to come? Have they been too restrictive? Have they stayed too long in your view? I know that's maybe not what you normally comment on, but are you worried about that?
Yeah, look, my view has been that the Fed loses the narrative, and that's my been concern is that you hold an aggressive hawkish stance too long. You don't allow for the fact that economic data, as it's reported, will tend to be lagging the underlying fundamental circumstance. And you wake up and you find that economic activity has been, in a decelerating mode, and now you have to go into overdrive and attempt to pull it out, right, with a more aggressive response, which is now what's happening, right? So the good news, if you will, is that we're now talking about here at Citi, two back-to-back 50 basis point cuts, September and November, then another 25 in December. So you're looking at a more aggressive response. Now I have to navigate what all this means for earnings via, economic sensitivity. And I got to tell you, Joe, our view has been pretty consistent here that we think you have to be clear on differentiating the S&P 500, i.e. that definition of Wall Street, from the broader economy in Main Street, where the S&P 5 is beaten to a different drummer fundamentally. So our earnings resilience call that we've been on for some time now doesn't change. I think what has changed is the positioning setup that on those three fronts that I mentioned have been sort of upended here. The pullback that we've had has alleviated a lot of the concern in terms of too aggressive growth expectations being priced in. So, yeah, we're now back to a point where I think we're looking at a more reasonable setup. Whether we're at the very end of this, very hard to say. As you go into periods of transition from Fed hawkish to Fed dovish or less restrictive, the volatility pickup usually is notable during those time frames. Economic activity does tend to kind of come in, and fundamentals can be under pressure. So even though we're getting closer to a more aggressive Fed pivot, doesn't mean coast is clear, but it sure means that we're setting up for a more traditional early cycle rotation.
Yeah, to be honest, I don't think we're going to see a big pickup in volatility. I think we're going to see a more aggressive Fed pivot. Doesn't mean coast is clear, but it sure means that we're setting up for a more traditional early cycle rotation. Yeah, to be honest, I don't think we're going to see a big pickup in volatility. I think we're going to see a more aggressive Fed pivot. Doesn't mean coast is clear, but it sure means that we're setting up for a more traditional early cycle rotation. That did not sound great to me in terms of where the markets go next. Normally, when the Fed cuts rates into a weakening economy, that does cause an over 20% crash. And I think that's probably when we could start to talk about a potential growth scare. Markets reevaluating where markets are, potentially around the time the Fed starts to cut rates in September. We're going to get a lot more data between now and September, and if that data does not improve, then I would expect a growth scare around that time. And also, if you guys want my honest opinion, I don't think it looks good today that markets were up a lot. I mean, for the S&P 500, well over 1%. And you sold pretty much all of that off today. There could already be more damage done under the surface from this Japanese yen carryover unwind than we even know about yet. And I do think that is a potential market risk here over the next coming weeks. I do think part of the kind of risk off appetite today is also super micro. Super micro today is down a lot. And for a company heavily related to NVIDIA, Supermicro is down 18%. For a company related to NVIDIA that does about 50-60% of their business with NVIDIA, that's not a good look. That is sending NVIDIA down about 2% today. Other big tech stocks are holding up a little bit. Apple is really the leader today, up almost 2%. Meta's down 0.5%. Google's up 0.2%. Microsoft up 0.3%, and Amazon is up 0.7%. And in case you were wondering, Warren Buffett now owns more T-bills than the Federal Reserve. What I also find a little concerning is the fear and greed index over on CNN. Now, to some degree, when there is extreme fear, that tends to lead to markets bottoming. Okay, but you've actually seen a bounce, a pretty aggressive bounce on the S&P from 507 at the lows pre-market yesterday up to 530 for the SPY, and you're still sitting in extreme fear territory. That doesn't look great to me. Market momentum, extreme fear. Stock price strength is greed. Stock price breadth is fear. Put and call options is extreme fear. Market volatility, extreme fear. Safe haven demand, extreme fear. And junk bond demand is also in extreme fear. And I have been talking about this for a while now. I do think you are going to be in a volatile trading range until we get that growth scare, okay? You're going to be in this state of volatility for a while, probably the next couple of months, where you can expect 2% up days, 3% down days, potentially as the new normal. It was kind of like 2022, where you never knew what you were going to wake up to, and the markets could go through vicious rallies and horrific falls. Now, tomorrow's data will be very important. You are going to get initial jobless claims that come out at 8:30 in the morning Eastern Standard Time, so an hour before the cash open. You're expecting 240,000 initial jobless claims. Last week, you came in at 249,000 initial jobless claims, and just a couple of days ago, the estimate was 250,000. So the estimate has fallen about 10,000 so far. And now you're expecting 240,000. If you come in high, like higher than last week, higher than 249,000, you're going to get more of those growth scares. You're going to get more of those recession scares that maybe the Fed is behind the curve. Why? Because initial jobless claims is seen as one of the most up-to-date data points that we get on the labor market. Now, it's not telling us the unemployment rate. It's not telling us the payrolls number, but it is telling us how many people are filing for unemployment, that have lost their jobs. Already at 240,000 per week is a high run rate, okay? But typically recessions are more so correlated to like 280, 320 so thousand jobless claims a week. That's where you start to really ask the question, are we in a recession? Are we going into a recession? And that's going to be very important coming tomorrow morning. You will also get continuing jobless claims. That's expected to fall about 7,000. If that does rise again, that will be a problem. You have really seen this ramp up in recent weeks. There's also some fear on Wall Street about a potential strike from Iran on Israel. This news came out at 11:40 a.m. today, Eastern Standard Time, that Israel's military chief says, quote, "We are at a peak readiness." So really anytime this attack could come, and that, again, will cause markets to be short-term fearful, okay? It doesn't tend to be something that is long-lasting, that is impactful more than a couple of days for markets. You've seen that with Russia and Ukraine. Sure, a day or two, the markets kind of panicked. But after that, it was back to the Fed. That's what we worried about in 2022. The worry of the sell-off was not related to Russia-Ukraine at that point. Now, it obviously depends what countries are involved and what kind of impact they have to the U.S. economy. Russia-Ukraine, not much of an impact to the economy. The biggest impact was to wheat because Ukraine is seen as the breadbasket of the world. Israel, Iran, they really don't have much of an impact on the U.S. economy. Maybe defense spending a little bit, but that would just likely go up, right? It's supporting Israel. So I don't see a correlation much at all to the U.S. economy and what this would mean for it. Now, if there was a larger conflict, more countries were involved, if we got involved directly, that looks unlikely, very unlikely at this point, like almost no chance of that before an election. That would be a bigger problem, but again, that just is so unlikely, it's not even worth talking about. Ryan Dietrich, on another note, writes on X, "I was taught a long time ago to never use the VIX as a percent and to always use points. The VIX closed down 10 points today, passed 3 times after the flash crash in May 2010, after U.S. debt downgrade August of 2011 and March of 2020. S&P 500 up a year later each time and up 27% on average." And yes, I too believe the S&P will be up a lot a year from now, as long as we are not in some kind of deep recession. I do think the growth scare will come, the recession maybe will come, and then what you'll see happen is investors will go back to buying after we sell off and panic. And then I think it's going to be really easy to say the S&P is up 20-30% if we start from an even lower level than we're at today. We do have some earnings today and after hours, none of which that are really going to move the broader markets, but some I do find important enough to mention. You have Robinhood today, Magnite, AppLovin, Digital Turbine, Sarepta Therapeutics, HubSpot, Oxy, Energy Transfer, Core Mining, and Dutch Bros. Tomorrow morning, you have Eli Lilly, Vista Energy, Plug Power, Datadog, Cheniere, Novavax, Kronos Group, CyberArk, Hillmax, and whatever this company is down here. And then tomorrow and after hours, you have SoundHound, Elf, Unity, Paramount, The Trade Desk, Array Technologies, CleanSpark, and Jinko Bioworks. Friday pre-market, you have Canopy Growth, Nikola, New Fortress Energy, Bry, Legend Biotech, and AMC Networks. Here on the day today, 10-year Treasury yields are up almost 7 basis points to 3.95%, and that is a sharp rebound from the lower levels we were at about 3.79% just pretty much yesterday. So to see yields rise, investors are not rushing into that safety trade. Bonds are seen as a safety trade. So when yields go up, that means people are selling the bonds. When yields go down, that means people are buying the bonds. That's why yields go down during times of extreme volatility, of panic, or when the Fed is cutting rates. Because investors, they want to get into safe haven assets, so they start to buy your 10-year Treasury. The percent of stocks above the 50-day moving average today is sitting at 41.84%. Not a great place, not a terrible place anymore. We were at about 30% of stocks only trading above the 50-day moving average about 2 days ago. Here today, you could see 2.5% of all stocks are breaking above their 50-day moving average. So let me know what you think about this information down below in the comment section. I will say the S&P 500 pretty strongly has gotten rejected at this 100-day moving average now 2 days in a row. You have been in a solid uptrend now though for 3 days in a row. So if we cannot break above this 100-day moving average over the next day or two, then it is likely you start to curl lower and start to retest the mid-teens, potentially low teens again for the SPY. This is the ETF that tracks the S&P 500. I also employ you to watch the RSIs. Now, the reason I called this bounce, when we bounced like 2 days ago, was because the RSI hit 30. Anytime you really hit 30 in the past on the SPY RSI, you've bounced. Besides the Rona drop, where you were actually overbought for a period in time, you do tend to bounce when the RSI hits 30. Like clockwork, that happened again. Now the RSI is at 37.2. That doesn't mean it's going to be straight up and to the right again. That just means, well, you've gotten your bounce. Does the RSI extend back to a more neutral level of 50? Or does it come right back down again? So ladies and gentlemen, that is going to go ahead and do it for this video. Hit that like button as well as subscribe to the channel if you have not done so already. It's free 99 and costs you absolutely nothing to do so. I will keep you informed of what's going on in our markets each and every single day and hopefully help you make more money. You guys have a great rest of your day again, and I will see you in the next one.